Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out what is really happening behind those fancy corporate filings. Today we're diving into Mercalot Incorporated's latest 10Q report, and let's just say there are some interesting numbers that tell a unique story. Can this company find its footing, or will it just vanish into thin air? Stick around to find out. And hey, if you like getting these kinds of raw looks at company financials, make sure you are subscribed, and also consider joining our Discord community for more discussions. Mercalot Incorporated is filing its quarterly report, and it covers the period up to the 31st of December 2025. Think of this as a financial checkup for the company to see how it is doing financially over the last few months. Let's jump straight into the numbers. Looking at their balance sheet, one of the first things that pops out is their cash position. As of the 31st of December 2025, they had about $19,000 in cash. That might sound like a lot, but compare that to the same date in the previous year, the 30th of June 2025, where they had a little over $39,000. So their cash has decreased significantly. On the other side, their intangible assets, which are things like the value of their mobile app and patents, are sitting at around $32,000. When you add up all their assets, they have a total of about $51,000. Now for the liabilities, which is what the company owes to others, they have accounts payable to related parties, which basically means money owed to people connected to the company, standing at $20,000. They also have deferred revenue, which is money received but not yet earned, at $17,000. And a related party loan is a significant $56,000. Adding up all their liabilities, they owe over $94,000. This is where things get a bit more concerning. Instead of a positive stockholders' equity, they have a stockholders' deficit. This means what they owe is more than what they own. As of the 31st of December 2025, this deficit is a whopping negative $42,000. This indicates that the company's liabilities are greater than its assets. Moving on to their performance, let's look at the statement of operations. This shows their revenues and expenses. For the 3 months ending the 31st of December 2025, they reported revenues of $7,500. That is up from zero in the same period the previous year. However, their operating expenses, which include things like general and administrative costs and amortization, were over $8,700 for that same 3-month period. This means they had a loss from operations of over $1,200 for that quarter. Now let's look at the 6-month period ending the 31st of December 2025. Their revenues were $13,000, but their operating expenses were much higher at over $44,000, leading to a loss from operations of over $31,000. This shows a clear pattern of spending more than they earn. Even though they're losing money, the net loss per S-Hair is reported as 0.00. This is because their losses are spread across so many shares that the per share impact is fractional, a common occurrence for companies with very low earnings or losses, but a large number of outstanding shares. Let's circle back to the stockholders' deficit, which gives us a clearer picture of how the company's equity has changed over time. The table shows a movement from a deficit of about $10,000 on the 30th of June 2025 to a much larger deficit of $42,000 by the 31st of December 2025. This worsening deficit is a direct result of the net losses they've been experiencing. Looking back at the 31st of December 2024, their deficit was around $11,000. So while the deficit has grown, it reflects the company's journey through its development stage. Now let's talk about cash, which is the lifeblood of any business. The statement of cash flows tells us where their cash came from and where it went. For the 6 months ending the 31st of December 2025, they used over $20,000 in operating activities. This means their day-to-day business operations consumed cash. In the same period, their cash flows from financing activities were zero. This suggests they didn't raise any new money through loans or issuing stock during this half year, which is a bit surprising given their financial situation. However, looking at the prior year, for the 6 months ending the 31st of December 2024, they actually had over $17,000 coming in from financing activities, mainly from related party loans and stock issuance. The net change in cash for the 6 months ended the 31st of December 2025 was a negative $20,000, bringing their cash balance down to $19,000 from $39,000 at the beginning of the period. This consistently negative cash flow is a significant red flag. Mercalot Incorporated was formed in Wyoming in April 2024. They describe themselves as a development stage company providing an online e-commerce and classifieds platform. Like an online marketplace, They've acquired a mobile app called Sedil Connect and a website. Their office is in Valencia, Spain. This is a critical note. The auditors are raising a big question mark about whether the company can continue to operate. They mentioned that the company had revenues of only $13,000 for the first 6 months of 2025, with a net loss of over $31,000 and a huge accumulated deficit of almost $70,000. They explicitly state that these factors raise substantial doubt about the company's ability to continue as a going concern. This means the company might not be able to pay its bills and could even go out of business. Management plans to get more money from investors, but there is no guarantee of success. Here they outline their accounting methods. They mention using estimates and assumptions, but due to their limited operations, the main one is believing they are a going concern. They also explain their revenue recognition following us generally accepted accounting principles, specifically emphasizing that revenue is recognized when earned, not just when cash is received. They also talk about deferred revenue, which is money received for services not yet provided. As of the 31st of December 2025, they have $17,000 in deferred revenue. This isn't necessarily bad, it just means they have obligations to fulfill. This is where they detail their purchase of the mobile application and website for $47,000. They are amortizing this cost over 5 years, meaning they are gradually reducing its value on their books each year. This note highlights that the company owes $56,000 to its directors, Blas Meyer Reyes and Isabel Marin Vargas. This is for working capital purposes and is outstanding and payable upon request. This shows a significant reliance on the company's own leaders for funding. As of the 31st of December 2025, they have over 5.7 million shares issued and outstanding. This is a lot of shares, which can make it harder for the company's value to significantly increase on a per-share basis if profits are small. The company has significant net operating losses or NOLs, which can be carried forward to offset future taxable income. However, they've established a full valuation allowance against these. This means they do not expect to be able to use these losses to reduce their taxes in the future, likely because they don't anticipate generating enough taxable income. This section is management's own explanation of their financials. They begin with a forward-looking statement notice, essentially a disclaimer that anything about the future is just an educated guess and could be wrong due to various risks. They admit they have limited operations and no significant revenue, and their auditors have issued that going concern opinion. Management expects to need more money from investors to fund marketing and operations. They describe their business as an e-commerce and classifieds platform focusing on Spain initially with plans for European expansion. They highlight the importance of marketplaces in today's digital world, mentioning global connectivity, economic empowerment, and efficiency. They list a wide variety of services from graphic design and to social media and business consulting. They also list numerous product categories, including digital goods, audiobooks, and even game accounts. This broad offering aims to cater to many different customer needs. They explain that their Sedil app is designed to be user-friendly with a focus on data protection, identity verification, and a built-in chat for communication. They are also planning future features like premium accounts, paid contractor packages, and advertising options to generate more revenue. They mention links to their app on Google Play and the App Store along with their website, indicating they have a live, if still developing, product. Their revenue streams are expected to come from advertising and partnerships. For advertising, they mention banner ads and pop-up windows. Partnerships involve lead generation fees and listing fees. They also offer price ranges for these services, showing their current pricing strategy. They detail future revenue opportunities like premium accounts, advertising campaigns, and analytics. They list current pricing for advertising and partnerships with ranges for clicks, monthly subscriptions, and listing fees. This gives us a concrete idea of how they plan to make money. Looking ahead, they project higher price points for premium user accounts, contractor packages, and advertising campaigns. This shows their ambition to monetize their platform more effectively as it grows. They state these prices are estimates and can change based on market conditions and customer feedback. They cite reports suggesting the e-commerce market is massive and growing, with Spain showing strong retail e-commerce growth. They believe a mobile lifestyle and local market focus are key advantages. Mercalot acknowledges that they face significant competition from global players like Craigslist and Alks. However, they believe they can carve out a niche in the Spanish market first, then expand into Europe. They note that competitors are much larger with more resources. Their strategy involves investing heavily in app improvement and marketing. Initially, their officers and directors will promote through word of mouth, and they plan to hire a freelance marketing manager. They list various marketing tactics from SEO to social media and influencer collaborations. Currently, they have no employees outside of their 2 officers and directors. This indicates a very lean operation heavily reliant on its founders. Their office space in Valencia, Spain is provided for free by their president, which is a cost-saving measure for the company. Mercalot Inc. qualifies as an emerging growth company under the Jobs Act. This status allows them certain accommodations, like delaying compliance with new accounting standards and not needing an auditor's attestation on internal controls. They have opted out of the extended transition period for adopting new accounting standards. They reiterate that their office space is provided for free and estimate its market value. They state they are not currently involved in any legal proceedings and are unaware of any pending actions. Here, management really lays out the challenges they admit to recurring losses and the need for additional capital, mainly through selling equity or debt. They highlight that the auditors have issued a going concern opinion, meaning there is serious doubt about their survival. They plan to raise money through an offering, but there is no guarantee of success. If they don't get enough cash, they may have to suspend or even cease operations. They have not achieved profitable operations and depend on financing to pursue their business plan. This re-emphasizes the going concern issue. For the 6 months ending the 31st of December 2025, they had revenues of $13,000 and operating expenses of over $44,000, resulting in a significant loss. Their cash balance of $19,000 is not enough to fund operations for long. They are relying on potential verbal agreements from their directors to provide loan funds, but there is no formal contract. Management believes that if they can't maintain their cease reporting status and implement their business plan, current investments could be lost. They also mention the purchase of the mobile app and website for $47,000. Their total assets are $51,000 with liabilities exceeding $94,000 and a stockholders deficit of over $42,000. This paints a picture of a company with very tight liquidity. For the 6 months ending the 31st of December 2025, operating activities used over $20,000 of cash. This continues the trend of cash being consumed by the business. They generated no cash from investing activities in either the 2025 or 2024 periods, and no cash was used either, indicating minimal to no investment in long-term assets. For the 6 months ending the 31st of December 2025, there were no cash flows from financing activities, meaning no new money was raised through financing. This is a contrast to the previous year when they brought in over $17,000. The company states they have no off-balance sheet arrangements, which are financial dealings not listed on their balance sheet that might impact their financial condition. They simply state none for market risk disclosures. This usually means they are not exposed to significant risks from things like interest rate fluctuations or currency exchange rates, likely due to their current stage of operations. Management acknowledges that their disclosure controls and procedures were not effective as of the 31st of December 2025. This means they are not confident that all required information is being properly captured and reported in a timely manner. There were no changes in internal controls over financial reporting during the quarter. They confirm no significant legal proceedings, no unregistered sales of equity securities, no defaults on senior securities, and no matters submitted to a vote of security holders. They state that no director or officer adopted or terminated any specific trading arrangements during the quarter. This section lists various certifications and documents attached to the report, like CEO and CFO certifications, which are standard for these filings. The report is signed by Blas Meyer Reyes, who holds multiple key executive positions, and Isabel Marin Vargas. The dates on the signatures indicate the report was prepared and signed in late January 2026. Now let's talk about what all of this means. Mercalot Incorporated is in a very early development stage, and that is very clear from these numbers. Their primary product, the Safe Deal Connect app, is live, but the financial reality is stark. They have very little cash, significant debts, and most importantly, their auditors are seriously questioning their ability to stay in business. The growing stockholders deficit and negative cash flows from operations are major warning signs for any investor. While they are trying to build a broad marketplace with many services and products, the key challenge seems to be generating enough revenue to cover their expenses. They are heavily reliant on outside funding, and the lack of concrete agreements for future financing beyond verbal assurances from directors is a big risk. The fact that they have no employees besides their 2 offices also points to a very small early stage operation. Looking ahead, their success hinges entirely on their ability to attract users, generate significant revenue from their planned advertising and partnership models, and secure substantial additional funding. The competition from established players is fierce, and they need a truly unique offering or strategy to stand out. Right now, the biggest opportunity is the potential of the e-commerce market itself, and their ambition to capture a piece of the Spanish and then the broader European market. But the biggest risk, as stated by their auditors, is that they might not be around to even try for much longer without a significant injection of capital and a rapid turnaround in their financial performance. So, what is the verdict? Mercalot Incorporated is a company in its infancy facing major hurdles. Their financial condition shows significant challenges with liquidity and profitability, and the going concern opinion from their auditors is a serious red flag. The story here is one of high risk, high potential reward if they can execute their expansion plans and secure funding, but a very real possibility of failure given the current numbers. Alright, that is our deep dive into Mercalot Incorporated's filings. What do you think about their chances? Let us know in the comments below. If you found this breakdown useful, please hit that like button and subscribe for more corporate insights. And don't forget, join our Discord community to keep the conversation going. Thanks for watching, and we'll see you in the next video.